Welcome back to the deep dive. Today, we are wrestling with a company whose story really embodies the promise and, well, the peril of the green energy transition. Eos Energy Enterprises, listed under the ticker EOSE.
That's right, a fascinating one.
We've got a stack of sources here detailing everything from their quirky chemistry to their, frankly, dizzying financial volatility. Our mission today is to cut through the noise and figure out this core tension for you. Is Eos the zinc-powered underdog that is truly positioned to disrupt the entire energy storage market with a U.S.-made solution? Or is its recent, absolutely eye-watering stock surge, we are talking up over 300% year-to-date, is that just a massive wave of hype and speculative capital just waiting for gravity to reassert itself?
That really is the essential conflict we have to unpack. Eos is fundamentally a strategic bet, you see, not just another battery company.
Okay.
Bet is on safely and crucially independently powering our industrial future. We're talking specifically about the extreme energy demands of things like new AI data centers and the urgent need to stabilize massive renewable grids.
And doing it without relying on China.
Exactly. Without any reliance on those China-dependent lithium supply chains. That's core to their pitch.
That concept, American-made independence, I mean, that's incredibly compelling from a strategic and, frankly, a political standpoint. They even have some powerful government backing, don't they?
They do, yeah, and it's a really critical piece of validation. They've secured a conditional U.S. Department of Energy loan guarantee. It's for $303.5 million.
Wow.
And $91 million of that has already been drawn down. This is a significant endorsement. It essentially signals that Washington views their technology as, well, strategically vital.
But there's always a but, isn't there?
There usually is. This is where the dive gets tense.
Yeah.
While the technology sounds revolutionary and the vision is, patriotic, critics looking at the balance sheet just cannot ignore the massive, relentless cash burn required to scale this whole operation up.
Okay, the scaling costs.
It's the classic innovator's dilemma, right? A high-risk venture capital type project now living out in the open on the public markets. So today, we really need to learn if this incredible high-risk bet has the operational muscle and the financial scaffolding to actually survive long enough to deliver that potential reward.
Okay, let's unpack this then. We need to start at the foundational level, I think, and build out the story piece by piece.
Right.
We have to start at the beginning. Explain Eos like I'm a total newbie, like I just heard the ticker mentioned on, I don't know, CNBC last week. What exactly is their technology, and what's the fundamental purpose it serves that maybe lithium can't?
Okay, let's start with the narrative. Eos was founded way back in 2008.
2008, wow.
Yeah, a while ago. In Edison, New Jersey, which is maybe appropriately kind of the spiritual home of modern innovation in the U.S., right?
So good point.
The company's name, Eos, it's derived from the Greek goddess of the dawn. It's meant to signal their intention to usher in a new era of energy. They didn't start by trying to build an EV battery, that's key. Their focus has always been grid-scale storage. And their core technology is the aqueous zinc battery.
Aqueous zinc, okay, that's the defining feature. We hear about lithium-ion everywhere. So what's the fundamental, molecular difference, and why is that so important for grid stability?
Well, the difference really boils down to safety in the supply chain. Lithium-ion batteries, they rely on flammable organic solvents in their electrolyte.
Right, the fire risk stuff we hear about.
Exactly. If they're punctured or overcharged, they can enter thermal runaway, which can lead to catastrophic fires. Eos's proprietary system, which they call ZNIFE, that's zinc hybrid cathode,
Yeah.
it uses a water-based or aqueous electrolyte.
Water-based, okay.
And that is a game changer. Zinc itself is a non-toxic, non-flammable element. And because the electrolyte is water-based, the whole system is fundamentally non-combustible.
That must make a huge difference practically.
Oh, immediately. It translates into lower insurance costs, easier regulatory approval, especially for utility-scale deployment in dense urban areas where fire risk is a huge concern. And then there's the supply chain piece. The choice of zinc is a huge strategic advantage.
How so?
Well, zinc is globally abundant. It's significantly cheaper than the more exotic materials needed for lithium batteries. But more importantly for this American-made thesis,
Yeah.
zinc is sourced primarily and abundantly right here within the U.S. That allows Eos to completely bypass the geopolitical volatility and the supply dependencies tied to that lithium supply chain, which, as we know, is largely controlled overseas.
That makes perfect sense, both from a security and a safety angle. Okay, now let's talk application. If they're not building batteries for EVs, what specific niche do they fill in the grid? What's the job they do?
Right. EOS is focused squarely on long-duration energy storage, or LDES. You
LDES.
can think of the overall battery landscape, maybe with a useful analogy. Lithium batteries, think of them as the sprinters.
Okay, sprinters, quick bursts.
Exactly. They deliver incredible power density, quick bursts of energy. That's essential for things like fast charging an EV or maybe providing immediate ancillary services to the grid for just a minute or two.
Got it.
EOS's zinc batteries, however, they're the marathon runners.
Ah, the marathon runners. Endurance.
Right. Their focus is on sustained, reliable discharge over a duration of, say, 3 to 12 hours.
3 to 12 hours. Why is that duration so critical?
Because it solves the single most expensive problem of renewables, that intermittency gap.
Ah, when the sun doesn't shine or the wind doesn't blow.
Precisely. They're designed to smooth out solar or wind power, basically, holding that energy for hours after the sun sets or, when the wind dies down.
Yeah.
Their real strength lies in durability and that sustained stability over hours. That's exactly what a utility needs to guarantee power delivery all through the night.
A marathon runner for the grid. Okay, that clarifies the role beautifully. And I guess that role is becoming exponentially more critical, especially with all the demand from new sources like AI.
Oh, absolutely. Beyond just smoothing out solar and wind, the use case has expanded dramatically because of the AI boom. Data centers, they require massive, reliable, and critically non-flammable backup power.
Right, you can't have a data center catching fire.
Absolutely not. If a massive compute facility loses power, the financial losses are just catastrophic. So the ability of EOS to provide reliable, non-combustible, multi-hour backup power makes them incredibly attractive to sectors with basically zero tolerance for downtime and high fire risk.
And it's all made here?
All manufactured in Turtle Creek, Pennsylvania, which importantly qualifies them for those critical domestic IRA tax credits.
Okay, but it's been, what, 17 years since 2008? If they're the underdog, they must have hit some major bumps on this marathon road, right? What were the biggest setbacks they faced, and how did they pivot to this incredible string of recent wins we're seeing now in 2025?
Yeah, it's been a long road. The early days, as is pretty typical for a fundamental chemistry innovation, were a painful R&D slog. Just proving the science, ensuring the cycle life, confirming that non-flammability actually translated to commercial viability.
Right.
The biggest, most immediate setback, though, was probably their financial entry into the public market. They went public via a SPAC merger back in 2020.
The SPAC boom.
Exactly. And that boom quickly turned into a bust for them. The stock just plummeted from highs near $30 all the way down to a desperate low under $1 just last year.
Under $1. That must have just destroyed investor confidence.
It did, and it forced a complete internal restructuring. It was a near-death experience, really.
So what catalyzed the shift? How do you go from under $1 to a 17x revenue jump year over year? That's insane.
It was really a confluence of internal execution improvements finally meeting massive market timing. First, the operational validation. Like you said, Q2 2025 revenue jumped an astonishing 17 times year over year.
17 times.
They transitioned, though it was painful, from a high-cost, R&D-heavy batch process to a more industrial manufacturing model. Second, they secured those really crucial market endorsements through significant partnerships, most notably with an energy giant like NextEra.
Okay, NextEra, that's a big name.
Huge name. But the single biggest catalyst, the thing that really signaled their exit from the startup phase into industrial scale, was that conditional U.S. Department of Energy loan.
The $303 million.
That $303.5 million.
Yes.
That money is the essential fuel that allows them to accelerate their manufacturing build-out. So it's this mix of market demand, some operational proof, and that government backing that provided the necessary lifeline and, frankly, the credibility to push forward with these really aggressive scaling plans.
That is quite the narrative arc, from near death to DOE-backed contender. But, the difference between a prototype working in a lab and a $300 million DOE-backed industrial operation, well, that often comes down to the person running the factory floor, right?
Okay.
Execution. That's the battlefield where all these promising startups either win or, well, die.
So who is the CEO, Joe Mastrangelo? And should an investor trust this particular person with their money? Especially given EOS's history of, let's be honest, turbulence, and some delivery misses.
Yeah, Mr. Angelo is the classic fixer archetype, you could say. He was brought in post-SPAC specifically for that reason, to scale the company out of the lab and onto the global energy stage.
Yeah.
He's not a chemist. He's not one of the founders. He's a 30-plus year industry veteran, hailing straight from GE Power.
GE Power. Interesting. Gas turbines and stuff?
Exactly. He spent his career running multi-billion-dollar divisions focused on large-scale industrial assets, gas turbines, setting massive efficiency records, big, complex projects. Okay, but why is a gas turbine executive the right person to run a zinc battery company? I mean, they seem like almost opposite ends of the energy spectrum, don't they?
You'd think so, but the core problem at EOS at that stage wasn't really the chemistry anymore. It was the manufacturing, the scaling.
Ah, okay.
Mr. Angelo understands large-scale capital deployment, supply chain resilience, and, critically, how to optimize a factory floor for efficiency and reliability. That's his wheelhouse.
Yeah.
His mandate was pretty clear: inject institutional rigor and capital discipline into what was essentially a volatile startup.
So what did he do first?
He immediately focused on strengthening the balance sheet. He successfully restructured their existing debt, managed to cut interest costs by 400 basis points, and extended the maturities. That bought them precious time, breathing room.
Okay, financial stability first.
Right. And the mantra he constantly reinforces is American made for American grids. He's trying to build this reliable U.S. industrial giant. He's also surrounded himself with key technical talent, like their CTO Saroj Sahu, who's the IP expert holding many of the core Zinc patents.
It's important.
And also policy-savvy board members, including some former DOE officials who can help navigate that complex political and regulatory landscape.
Okay, the resume sounds stellar, fits the bill, but the history is still spotty. Let's press on that biggest historical criticism, those past delivery misses and execution issues. The sources we looked at note that pre-2025 delays really hurt their credibility. Is execution risk still the most crucial challenge for EOS today? And how can we or an investor trust the company to deliver on its massive backlog now?
You're hitting on the precise point where the bear case is strongest. Absolutely. The execution risk was the critical vulnerability. That transition from R&D to high-volume manufacturing, it's notoriously difficult. Many companies stumble there. And EOS definitely struggled with quality control and throughput optimization for years. That's why the stock suffered so dramatically.
Okay, but wait. If they are making such massive operational improvements now, our sources claim throughput is up 4.8 times on line 1. How do we reconcile that with the fact that their Q2 revenue, that $15.2 million, still missed analyst estimates by, what, about 40%? That seems like a disconnect. It suggests the internal improvements aren't maybe translating fast enough into predictable sales, which is what the market really wants to see.
That is the crucial tension right now. You've nailed it. The operational metric, that 4.8x throughput, that's an internal measure. It shows how efficiently the factory floor is moving product through the manufacturing process itself.
Okay, internal efficiency.
Right. The revenue miss, that relates more to the conversion of that finished product into actual customer-ready installed units. That involves logistics, installation, final commissioning, getting the final payment. It's really the last mile of the process.
So the factory's faster, but getting it out the door and paid for is lagging.
That seems to be the case, or at least where the bottleneck shifted. The 4.8x throughput increase on line 1 is strong evidence that Mastrangelo's industrial approach is working on the factory floor itself. They are definitely moving away from those manually intensive batch processes toward automated, repeatable, continuous flow manufacturing.
Which is essential for scale.
Absolutely essential. But it's a massive, complex change. Now, line 2, which is critical for them reaching their bigger scaling goals, is scheduled to launch by the end of this year. If they can replicate the efficiency gains they achieved on line 1, but do it on line 2, then that Q2 revenue miss might just become a historical footnote, a blip.
The big if.
It's a big if. Until that factory efficiency translates reliably into predictable, ideally margin-positive installations, the execution risk remains high. The recent data points suggest the operational engine is finally engaging, sputtering to life, maybe, but they are definitely still in a race against the clock and against their cash burn.
Okay, that shifts the discussion neatly. It's not about if the technology works anymore. It's about how reliably and quickly they can convert that technology into actual cash flow. So let's talk about that cash flow, or lack thereof. This stock, as we said, has been a wild ride. Let's just touch on the volatility first. The beta is 1.67, volatility 75% higher than the market. For the listener, maybe not steeped in finance jargon, what does that mean in just practical terms?
It means this is a highly speculative, high beta stock. It is absolutely not for the risk-averse investor.
Yeah.
Beta measures how much a stock's price tends to move relative to the broader market, like the S&P 500.
Okay.
A beta of 1.67 means that if the S&P 500 moves up 1%, EOS's stock is statistically likely to move up 1.67%. But the reverse is also true.
So it magnifies market moves up and down.
Exactly. When the market's hot, EOS can soar.
Mm-hmm.
When the market dips, EOS tends to crash harder. As of September 2025, the price is hovering around $10.65, sitting on that incredible 312% year-to-date surge. That values the company at about $2.97 billion.
Nearly $3 billion.
Right. And that valuation is almost entirely based on future potential, future hopes, not on current financial stability.
Okay. So let's break down the three most important numbers an investor needs to wrap their head around right now: the growth, the loss, and the sheer potential. Give me the explosive growth story first. What's driving that?
Well, the growth narrative is frankly staggering. We already mentioned that Q2 2025 revenue hitting $15.2 million, the 17x jump year over year. That is the kind of hyper growth you usually only see in like pre-IPO startups, not typically publicly traded industrial firms.
Yeah, it's huge.
And management is guiding for full-year revenue between $150 million and $190 million. That translates to an incredible 862% to 1,118% increase from the previous year, 2024.
Just astronomical numbers.
They are. But the real conviction for the bulls, the true believers, it comes from the order book. Their current backlog, and this represents firm binding contracts, stands at a massive $672.5 million.
Wow, over $500 million in confirmed orders.
Right, representing about 2.6 gigawatt hours of storage. And importantly, it's still growing, up 15% just quarter over quarter.
Okay.
And then beyond that, the longer-term pipeline, these are more like qualified leads, potential future contracts. That's an almost unbelievable $18.8 billion.
18 billion.
With a B.
With a B. Now, that's pipeline, not backlog, so it's less certain. But that pipeline visibility gives investors confidence that the demand is incredibly robust and can sustain growth for years if, and it's a big if, they can actually build and deliver the product profitably.
Okay, the potential is just undeniable. The growth trajectory looks vertical on a chart. But we cannot look away from the other side of the ledger. Where is all this massive cash burn coming from? If they have all this demand, why are the operating losses so staggering? It seems counterintuitive.
It does, but this is the massive risk factor. This is the reason the stock price swings so violently day to day. EOS is operating deep, deep in the red because they are essentially building an entirely new, massive industrial infrastructure completely from scratch.
The money is just pouring out into fixed costs, building out line 2, optimizing line 1, increasing their inventory of raw materials like zinc, investing heavily in continuous R&D to keep refining this ninth technology. It all costs money before you get paid.
And the numbers reflect that burn.
Oh, painfully so. Look at the Q2 financials again. The adjusted EBITDA loss was a staggering $51.6 million for the quarter. Their operating margin for that quarter was negative 2,208%.
Negative 2,000%. How is that even possible?
It sounds impossible, but to put it in perspective, it means that every dollar of product they actually managed to sell and recognize revenue on. It cost them roughly $22 to produce, manage, and cover operating expenses.
$22 out for every $1 in. Ouch.
Ouch is right. They're sacrificing current profitability entirely, burning cash like crazy in service of achieving future scale and capturing this enormous market opportunity before competitors do.
That negative 2,208% margin, though, that's the kind of number that terrifies traditional fundamentals-based investors. How can they possibly sustain that kind of burn rate for long?
Well, the short answer is they can't. Not in the long term. Which is why financing is absolutely everything for this company right now. The good news on that front is they have recently shored up their liquidity position. A recent capital raise brought in $336 million.
Okay, that's significant.
It is. And when you combine that with the drawn portion of the DOE loan we mentioned, their immediate cash position jumped up to $183.2 million. That cash injection provides the necessary runway, the cushion, to continue the aggressive build-out of Line 2 and eventually Line 3 without the immediate fear of insolvency hanging over them.
So they bought themselves some time.
They bought time. However, the market demands and, frankly, needs to see that this cash burn starts decreasing significantly over time as scaling leads to better efficiency. Management knows this. The leadership is targeted at achieving free cash flow positivity sometime in 2026 or maybe 2027.
That's the target horizon then, 26, 27.
That's the target. If they miss that target, they will almost certainly need to raise more capital. And that leads directly to the dilution risk that the bears constantly, and rightly, highlight. Every time they sell more stock, existing shareholders own a smaller piece of the pie.
Right.
It's like you said, they're a rocket fueling up incredibly high burn right now, hoping desperately to reach orbit in maybe 2 years. But failure to launch means a spectacular, fiery crash.
That is a perfect and maybe slightly terrifying summation of the conflict. It really is the ultimate high-risk, high-reward proposition, and it's all grounded in the absolute necessity of flawless operational execution. Okay, now let's really stage the final battle. The bulls versus the bears. Why are sophisticated investors, why are energy giants like NextEra willing to bet hundreds of millions of dollars on EOS right now? Give me the strongest, most compelling case for massive growth. Why be bullish?
Okay, the bull case really rests on 3 main pillars: the technology itself, the market inevitability, and what they see as asymmetric upside potential.
All right, technology first.
First, technology. We've already established the non-flammability and the domestic supply chain advantages. Those are huge selling points. But the core financial advantage, the number bulls point to, is the levelized cost of storage, or LCOS.
OCOS, explain that quickly.
LCOS is really the truest metric of long-term storage cost. It's the total lifetime cost of deploying and operating a battery system, divided by the total amount of energy it delivers over its entire lifespan.
Okay, the all-in cost per unit of energy stored and delivered.
Exactly. And EOS's zinc technology, bulls argue, offers a 30% lower LCOS compared to lithium-ion, specifically for these long-duration energy storage applications.
30% lower? How?
It's achievable, mainly because the zinc raw materials themselves are cheap and abundant, as we discussed.
Whoa.
But also, critically, the batteries degrade incredibly slowly. EOS projects only about 7% degradation over a 20-year lifespan.
Wow, they last a long time.
They're built to last. For utilities and data centers building infrastructure that's meant to operate for decades, this long-term cost reduction is paramount. It outweighs higher upfront costs sometimes.
Okay, lower long-term cost. And the market timing piece, that massive tailwinds, that must be absolutely central to the bull argument, especially with the AI energy crunch we keep hearing about.
Oh, it's the defining feature of the bull case right now. The AI boom is driving just unprecedented demand for stable, reliable energy.
Yeah.
We're talking about U.S. data centers potentially needing an additional 15 to 30 gigawatts of power capacity by 2030.
Staggering numbers.
They are. And EOS says about 20% of its current sales pipeline is dedicated just to these high-stakes data center and AI applications. These critical infrastructure facilities, they simply cannot tolerate the fire risk associated with lithium, especially in dense backup power deployments inside buildings.
Right.
So EOS's zinc solution is positioned as essentially insurance against catastrophic failure.
Yeah.
That makes it highly desirable almost regardless of the immediate installation cost for some customers.
Okay, tech advantage, market demand.
Yeah.
What about the financials from a bull perspective, the upside?
Right. Second, financial upside. If, and again, it's the big deal, if they successfully convert that massive backlog and execute their scaling plan effectively, the revenue trajectory is just enormous. Converting that current backlog alone could drive $1 billion to $2 billion in annual revenue by maybe 2030. That implies something like a 50% compound annual growth rate from here.
Huge growth rate.
And some analysts suggest that if EOS successfully scales its manufacturing capacity up to 8 gigajoule by 2027, the upside potential for the stock could realistically reach $25 per share. Compared to around $10 now, the reward potential looks huge.
Okay, $25 target. What's the third pillar?
Valuation? It seems expensive now. Third, valuation. Well, while the current losses are massive, some analysts argue that EOS is actually cheap if you look further out, based on forward-looking revenue projections. Compared to some peers like, say, Fluence, which trades around 1.0 times next year's sales estimates, EOS trades at about 2.6 times its projected 2026 sales.
So a premium, but maybe justified.
Bulls argue yes, that the disruptive, defensible technology warrants that premium, especially when you factor in the high short interest in the stock. That provides the technical potential for dramatic short squeezes if they manage to hit a major operational milestone or deliver a surprisingly good earnings report.
Okay, I'm definitely inspired by the potential of the technology and the clear, desperate market need. But now, play devil's advocate. I need to know what the bears are growling about. What justifies their extreme skepticism and those continued massive short positions against the stock?
All right, devil's advocate time. The bears look right past the shiny technology story and straight at the cold, hard financials and the company's execution history. First and foremost is dilution risk. We've touched on this, but it's central to the bear case.
The constant need for cash.
Exactly. The persistent and massive operating losses mean the company is just bleeding cash. They currently carry a staggering $1.1 billion accumulated deficit on their books. To fuel expansion, they have already significantly increased the number of shares outstanding. It's up about 50% just year to date.
Wow, 50% more shares.
Yeah. And the risk of further stock dilution is extremely high. Every single time they need to raise more cash by selling stock, existing shareholders pay the price by owning a smaller percentage of the company. It erodes value per share.
Okay, dilution is number one. What else?
Second is execution history and backlog concentration. While we noted the recent improvements on line 1, the past spotty track record is really hard for bears to overlook. They see a pattern of overpromising and underdelivering.
Trust needs to be rebuilt.
It does. Furthermore, that huge $672.5 million backlog isn't entirely risk-free money in the bank. Bears point to risks related to individual customer concentration. They cite past issues, like litigation or financial problems with major contracted parties, such as the bankruptcy involving a project called Penagate.
So customer risk within the backlog.
Exactly. If just a few of those massive contracts fail to convert smoothly, maybe they run into permitting delays, or the customer has financial trouble, the company's entire financial outlook could collapse very quickly, forcing yet another dilutive cash raise.
So the backlog itself isn't guaranteed money until it's installed and paid for. It depends on their ability to manage these really complex customer projects, which is always a massive hurdle for a company that's scaling up this fast.
Precisely. Project management becomes critical. And third, competition and valuation. You just cannot ignore the deeper-pocketed lithium giants like Tesla, CATL, LG Chem. Even if EOS focuses specifically on LDES,
They could pivot.
these behemoths can adapt quickly if they see a profitable market, or they could simply outspend EOS on manufacturing scale, driving down costs through sheer volume in ways EOS can't match yet. And the final point the bears hammer on is the current valuation metric.
Yeah, back to valuation.
Trading at an astronomical 59 times enterprise value to current sales ratio leaves absolutely zero margin for error. Any significant delay in launching line 2, any further quarter-on-quarter revenue miss, any failure to start dramatically decreasing those negative margins, you could see a very sharp, very painful reassessment of the company's value by the market. Downside risk is projected by some bears towards $6 per share, maybe lower. This stock is priced for absolute perfection, and perfection is hard to achieve.
Wow. It is just a beautifully balanced yet absolutely terrifying picture. Revolutionary technology and massive market need on one side versus a really frightening financial structure that demands perfect operational execution on the other. Okay, let's try and look forward then. If EOS is going to successfully navigate this high-wire act, they absolutely need a real defensible competitive advantage, a moat, as they say, that keeps these deeper-pocketed competitors out, at least for a while. What is that moat, really? And maybe more importantly, can they actually execute their ambitious scaling plan, especially since, as you mentioned, that crucial DOE loan depends on it?
Yeah, the execution timeline is the immediate stress test, no doubt, and it's tied directly to that DOE funding. The first step, which we discussed, was automating line 1, getting that 52% increase in throughput by moving to continuous processes. That proved the internal thesis, that they can industrialize.
Okay, proof of concept on line 1.
Right. The next critical steps are launching line 2 successfully by the end of this year and then immediately focusing on margin improvement to ensure they can make these things profitably, or at least path towards profitability. And the conditional nature of that $303.5 million DOE loan, that's vital intelligence for you, the listener. The future tranches of that loan, the later payments, they depend entirely on EOS hitting specific pre-agreed operational milestones.
Like what kind of milestones?
Things like achieving certain quarterly gigawatt-hour production run rates and demonstrably improving operational sufficiency and, crucially, gross margins, hard numbers. Failure to hit those metrics means the government funding could stop.
High stakes indeed.
It's extremely high stakes. It makes the Q3 and Q4 2025 earnings reports absolute must-watch events. We need to see evidence of efficiency gains, not just higher output. The overall target capacity they've stated is 2 GWh by mid-2026, and then a massive ramp to 8 GWh by 2027.
Okay, assuming, big assumption, they execute that plan successfully, hitting those DOE milestones, what is the ultimate layered competitive advantage? What's the moat that will sustain EOS beyond just this immediate hypergrowth phase?
Well, I think their moat is being built on 3 pretty strong pillars. And these are things that are difficult for large competitors, even the lithium giants, to replicate quickly. First, safety and supply chain. We keep coming back to it, but it's fundamental. The inherent non-flammability of the aqueous zinc chemistry.
Can't be overstated.
It really can't. Combine that with their IP-protected Zin architecture and that guaranteed domestic U.S. supply chain for zinc. It creates a really defensive perimeter. They are effectively selling energy independence and safety, which is becoming a non-negotiable factor for critical infrastructure providers and, of course, the federal government itself.
Okay, safety and domestic supply. Pillar 1.
Second, the software layer. This is newer, but really important. They introduced something called Dawn OS on September 8th.
Dawn OS, what's that?
It's essentially a battery operating system. It's designed to use AI-like controls to optimize the performance, the charging, the discharge cycles of their battery systems, specifically for different utility needs or customer requirements.
So making the hardware smarter.
Exactly. This is about moving EOS from being just a hardware provider, just selling boxes, to becoming a smart energy solutions firm. This software layer, it not only increases the performance and potentially the lifespan of the hardware itself, but it also introduces the potential for a high-margin, recurring software-as-a-service revenue stream.
Ah, recurring revenue, the holy grail.
It is, and that creates enormous stickiness with utilities. Once you're integrated with Dawn OS managing their grid assets, the switching cost to rip it out and go with someone else become very high.
Okay, that's a key detail, turning a one-time hardware sale into a longer-term recurring revenue stream that could definitely strengthen the long-term financial stability picture.
Absolutely. It's a critical part of the long-term investment thesis. And finally, the third pillar is simply the context. The sheer size of the ocean they're swimming in. The total addressable market, the TAM, is just gargantuan.
How big are we talking?
Well, the global battery storage market overall is projected to skyrocket from around $32.6 billion this year to an estimated $114 billion by 2032. That's maintaining roughly a 28% compound annual growth rate.
$114 billion.
Huge market.
Massive. And EOS is focused on that LDES subset, the long-duration storage market. That slice alone is projected to grow from about $10.7 billion today to around $44 billion by 2030.
Still enormous.
Still enormous. The confluence of, mandated renewables integration, Bloomberg NEF projects 94 GW of storage added globally just in 2025, combined with the relentless power demands of AI, it creates a demand curve that is practically vertical right now. So the market size is clearly not the problem here. They don't need to capture a huge share to be successful.
It's not the problem at all. So the verdict really remains one of asymmetric upside potential. The potential returns, if they execute flawlessly, could be 2 to 3 times the current share price. That's weighed against a very real downside risk of maybe 50% or more if execution falters or they hit financing issues.
High risk, high reward.
Exactly. If EOS succeeds in reaching that 8 kWh target and manages to capture even a modest 4% to 10% of that rapidly expanding LDES TAM, they will be generating billions in annual revenue. EOS is, in many ways, the ultimate embodiment of that American industrial grit narrative, betting everything on a domestic, non-flammable solution to try and solve the energy backbone crisis for this new age of infinite compute.
That is an immense story of potential and, significant risk. Hashtag outro, rapid recap, and final thought. What an incredible deep dive into EOS Energy. Just fascinating.
Let's do a really quick rapid-fire recap of the 5 key themes we covered for you today. First, this is the quintessential zinc-powered underdog story, right? Focusing on the inherent safety of aqueous zinc and the strategic advantage of a U.S.-based supply chain, dating all the way back to their founding in 2008.
A long journey.
Second, the leadership under CEO Joe Mastrangelo. He's the GE veteran focused squarely on turning operational execution around, leveraging his industrial expertise to try and convert the company from an R&D lab into a fully automated factory. The current operational data looks promising, but that history of misses still adds a layer of risk.
Execution is key.
Third, that stark financial conflict. It's extreme.
Yeah.
You've got explosive revenue growth and a massive $672.5 million backlog on one side, juxtaposed against, frankly, frightening cash blind, leading to things like a negative 2,208% operating margin in Q2, which requires continuous financing and raises that specter of dilution. The burn is real.
Fourth, the high-stakes debate between the bulls and the bears. The bulls see that $25 per share potential, driven by the massive demand from AI and renewables, plus that LCOS advantage. The bears, though, focus relentlessly on the high stock dilution risk and the absolute need for flawless, profitable execution going forward.
2 very different lenses.
And finally, number 5, the defensible moat they're trying to build. That combination of zinc safety, domestic supply, their IP protection, and that crucial new Dawn OS software layer. all positioned in an exponentially growing LDES market that desperately needs exactly what they are selling if they can deliver it.
That sums it up well. My final take is really that EOS is the quintessential high-risk, high-reward play on America's energy future. The upside potential is tremendous, no doubt, but the volatility is extreme, and the operational execution simply must be perfect to secure that ongoing DOE funding and sustain the massive growth required. It is definitely not for the faint-hearted investor. You absolutely must do your own homework and fully understand the risks inherent in this kind of aggressive, capital-intensive scaling model.
A perfect, critical summation. Okay, and here is a final provocative thought for you to chew on this week, listener. If EOS does successfully execute its scaling plan, if it becomes the reliable, non-flammable domestic zinc battery hero, how will that specific success maybe solidify the political and industrial necessity of onshore, non-Chinese manufacturing for all critical energy backbone technologies? Could it fundamentally reshape global supply chains? Because the demand for energy stability, especially driven by AI, it feels like it's only just beginning.
Something to think about. Stay curious.
Until next time, decode wisely.